Hello, ladies and gentlemen, and good morning. Back from holiday and feeling refreshed, so let us quickly look at the situation in bonds, as always, the driver of all other markets. As we predicted, here we are, we're still within that 275 to 3% range. That has been established for several months, certainly been holding since April, May. We caught the move up and now we are in the downdraft correcting that move. We are now forming a triangle, as you can see, and that will probably last for another few weeks until we get the final move, which we still expect to be up to the upside in yields, and which will probably be the death knell for the equity market. But for the time being, nothing left to do but to take in premium for the 10-year, anything between 280 and 3% trades for the next several weeks. TLT, so the slightly longer 20-year on average, well, we are still basically trading all around this trend line, which is very, very important. The 200-day moving average is still positive. It's still got a positive slope to it. We keep on trading underneath it and touching it. That 125 level that we stressed still hasn't been tested, but that will be the very, very important level. If it breaks through 125, then we could be off to the races again to the new highs. But for the time being, it looks like it's more likely to break down at some stage. 117 is very important, and there's a lot of support there to 125, where there's a lot of resistance. Basically, that is the trading range for the time being. We still expect it to break lower at some stage and come and test the 101 level, but for the time being, nothing to do apart from watch the trading range of 125 to 117. Going to Europe, and this is the 5-year. It didn't quite reach, unfortunately, the levels that we hoped, around minus 35. But here we are stuck in this trading range, basically now from 30 minus 36 up to about here, which will be minus 0.05. So a 30 basis point range, completely unexciting. Only if we break through that will we have a move potentially higher to 28 basis points. But it just doesn't look like it. If we have a look at the 10-year, much the same thing. We are between 65 basis points and 25 basis points, 40 basis point range, still expected to break higher, but nothing. The one that is beginning to be exciting is the Italian bond. Anything around the 260 area, we should be buyers for a move back up towards the highs around 380. This is the market that is in trend, and this is the one that we should be trading. The one market that is beginning to be exciting is DXY. It finally managed to close above 95.07 on a weekly basis. That is a very important level, and all indications is that we are now going to the very important pivotal level of 96.50, which should coincide with something like 112 in Euro USD. That is what we are expecting for the next couple of weeks, a move up to 96.50 in DXY. If we have a look at this chart, which is a weekly chart, that gives us this trend line on the weeklies around the 96.50 area as well. We are very much dollar bulls at the moment, and that indicates to us that equities have very little very little space on the upside to move, which we will look at next. But this is very much an interesting market to trade for 96.50 in the DXY. If we look at Euro USD, we have the 200-day moving average. here at 113.36. That is what we expect over the course of the next few days. Basically 116 down to 113 will be the move that we are hoping for to make DXY go up to the 96.50 level we mentioned. Should be quite quick, 3-4 days worth of trading, and then 112, which is this level which has held, which has been pivotal rather, for many months and years. This will be the level that when we test it, it'll basically dictate. If we break through there, we have nothing until the lows down towards 104. So stay short Euro USD and be long DXY. As far as US equities are concerned, basically we have a ratchet higher back to the all-time highs around the 2870 area. The Bollinger Bands are expanding, and we certainly see upwards steps towards the 2875, 2890 region, but it's going to be very slow with low volatility, and therefore you are looking to make 5-10 quick basis points. That's all you're looking for in this market. It's not a buy and hold market. It's not a load the boat, because as we will see next, we are showing some enormous cracks in the spreads, something that we haven't seen really since we were in this area here, and this is beginning to be very important for the next few months. It could be a very hot autumn and winter, simply because the spreads are indicating that we might be very close to a change of long-term trend. Nothing to do at the moment, but the first cracks are here and the warning signs are very loud. What are these warning signs? Well, the first one is a spread indicator that we look at all the time, which is the semiconductors over the yen. This tends to trade very fast and remain in trend for long periods. As you can see here, basically it's held you long technology all the way from from the summer of 2016. It caught the whole trend of 2017. It didn't get you out in early 2018, and it has held you all this time long of technology stocks, and has worked beautifully. It is beginning to give up the ghost. We would have expected now for this market to have made new highs. It hasn't. It is in a very tight range, and it is catching up to the 200-day moving average and to this very important trend line which has held it from the lows. That to us is a warning sign. This should be making new highs, and it isn't. Normally it's what the markets don't do which tells you which way they are going to go next. This could at some stage, certainly not in the next couple of weeks, but at some stage it could break down quite violently. But this is by no means the only indicator. There are plenty of others. This is a very long-term chart of QQQ against SPY. If we enlarge it here, we will see that it's very unlikely that this market will make new highs. It is now turning over on the slower moving averages, and it is quite possible that it goes and retests down towards the 200-day moving average, basically erasing everything it's done since May of this year. As you know, we have for a long time argued that America is XLK. XLK, or the Qs, more or less identical chart, and if technology now starts underperforming significantly, the only thing that can hold up the market is basically XLF or XLI. Nothing else is large enough to hold up this market, and this to us is a very worrying pattern the fact that the market is approaching new highs and the technology sector cannot keep pace with the underlying index. Very worrying. The first worrying sign, this could be very quick when it happens, probably a few days up here, and then if it starts breaking down, we will know that NQ cannot hold, and we will look at that later. XLK over XLF. As you can see, XLK tried to break out, failed, back in, back to support. Not a great pattern, absolutely something that we should watch, because now we could have the start of a move all the way back down to the bottom of this trend line, and this could certainly be a rout in technology at some stage. Quite a worrying pattern, another sign that not all is as it seems within the internals of the market. You will remember this chart, which is the Dow against the QQQs. We tweeted when it was right here, when it reached the trend line. It's a beautiful channel, it's still in force, and look how much it has given up since. This is a pattern which should not be happening while the market is trying to make new highs. We should be quite a little bit lower. We should be hugging this lower trend line. This to us again is very worrying. It indicates that people are rotating out of high beta stocks into conservative and defensive stocks. People are not sure, people are defensive, and this is not a good sign when the markets are making new highs. Another warning sign, this is SPY against gold. Very, very long-term trend line up here. We are at it. This could be very much the same as we saw with the QQQs and against DJI, a sign that the market needs a pause to come back. Again, this is not something that we would like to force and be overly long of equities at these levels. The market is giving you a clear sign that the equity market is overbought, and therefore to be opportunistic rather than position for long-term moves. Having looked at all the spreads and just the mere warnings that are there, let's have a look at the underlying market which should be driving us, which is NQ. If we now enlarge this trading area, what we are seeing is that we have these Bollinger Bands up at towards 7,500 basically. So what the market is saying is that if we can't take out 7,500 and remain strong, all that's going to happen is that the stochastics are going to get to overbought within 4 or 5 days, and then we could have a very quick downdraft towards this moving average around the 7,200. But this time it's unlikely to hold because of the pattern, and then we could go all the way down to where we were below 7,000. It's a warning sign again. It's not saying it's gonna happen, it's saying it could very, very easily happen. Risk reward at 7,500 is to buy puts. All the other regional markets that we look at, be they in Asia or in Europe, and this is the stocks, just can't get out of their own way. If you have a look at the last few days of trading, all we are doing basically since the holidays, all we are doing is basically we're hugging the 200-day moving average, which is turning negative. Anything around 3,500 gets sold, and then we come back down towards the 50-day or the 100-day moving average. Not a great pattern, not a market which has any conviction. We are quite likely to do something like this again and test lower levels around the 3,400. Again, when the market is 3,500 or above, the risk reward is to buy puts. So which sectors of the market are actually performing and holding up and causing the outperformance of ES now over NQ, i.e. the reversal of the trade that has been going on since basically February this year, when technology led us out of the slump. Here it is, XLF. as we mentioned, XLF needs to drive. Is this in a position to drive? Probably not. We still have these levels here around the 2830 to 2850 area, which we have not been able to break, but it's going to take some time. What we are saying is that the market is unlikely to collapse, but the internals are changing very rapidly, and that is the first warning sign for much later on in the year when something could well be afoot. At the moment, it's XLF outperforming XLK, which is driving the steadiness of the spread coming out between ES and NQ. And same for XLP. Now, this is very important because what it means basically is that ever since the summer started, people have been putting their money in defensive stocks. XLP, as you know, is just about as defensive as you can get, and it's approaching 55.25. XLP alone can't hold up ES, but it's showing you where the money is going. It's going in the most defensive sectors. It's going into big financial stocks like JP Morgan. It's going into Goldman Sachs, and it's going into the J&Js and the people who have very steady incomes as opposed to people who have high beta, and therefore that is a first sign of rotation out of the FANGs. And just to take you back to DXY, and a question, what is most logical if you are going to have a stronger dollar, and it might easily even break 96.50, although without a doubt we think we're going there. If we break 96.50, what is going to happen to the market? Well, it's obvious that the only strong sectors in the economy in the US are going to be the domestic ones. So XLP and the health sector, so XLV, those sectors are going to vastly outperform the one which is internationally traded like XLK or even XLY. And that is why you're getting those movements. It is all being caused by the dollar. A strong dollar is actually making domestic stocks in US, the defensive ones, far more attractive than the others, and therefore high beta is suffering and low beta is actually taking over. This is a defensive move from the market as a result of a higher dollar and a potentially much higher dollar over the next few months. If this trend continues, we will at some stage reach a level at which even those stocks that are defensive can no longer take it. That might be caused by a spike up in bonds as a result of inflation resulting from tariffs, and that would bring down the whole of the US market crashing down. We are not nowhere near there at the moment, but we are just saying what the symptoms are, and the full illness might take a long time to develop. But this is a beautiful chart. You just have to be long of DXY and long of ES or XLP or XLV on dips against the high beta stocks which are in XLK. And just to stress that point, this is XLP over XLY. Would you be expecting XLP against XLY to be breaking out of an inverse head and shoulders and going back into the channel and probably back up to the 200-day moving average while the market is trying to make new highs? The internals have changed completely, which again does not mean that ES needs to come down. It just means that ES is steady to ratcheting higher, while the technology sector is unable to do the same. The technology sector is more likely to have very quick downdrafts of 1 to 2%, while ES has a 0.25% downdraft. Then ES slowly recovers, while NQ recovers nowhere near as much. And that is what is likely to happen for the rest of this month. And the reason why we think ES has very limited upside at the moment is because even the defensive sectors are very stretched. You saw XLP just now, that is stretched. This is XLV, this is also stretched. There's nothing in here that can make more than 1 or 2% to the upside before it comes back the same amount. Therefore, that to us indicates a narrow trading range in ES and a wider trading range in NQ. Basically, the play would be to sell puts in ES and buy puts in NQ, giving up some premium. That seems to be the most logical play, or just the spread between the two. So as to the biases, well, nothing's changed here, but we still expect it to break higher at some stage. We take in premium for the time being. The bubble and the bund, we're not going to change these levels for now, but to us, Italy is now unlikely to do any better on a spread to Germany. People are still buying like crazy the safety of Germany, and probably it's definitely not worth going against it. This is what we wrote. We cannot see significant strength beyond 28.30 if the US dollar is strong. That still applies. We are unlikely to break 2700 at any moment now, but this very much still applies. The elevated tail risk is present both to the upside and to the downside. In the end, we will not be surprised by an acceleration higher in ES sometime in the autumn. They will say there's no more trade war or something like that. We'll get a brief spike in ES of 100 points, touch 3,000, and then come off very rapidly. But that is far too far away for us to worry about. At the moment, all we are seeing is that NQ is no longer the leader, and it has always been the leader. The market has been unable to go up without XLK, which is NQ, and at the moment it is able to do that. Therefore, the internals are changing, and with the internals change, we have to be very, very careful, because what we are saying is that SPX is going to be steady while NQ is going to be very wobbly. Volatility, we haven't looked at it simply because there isn't much going on there, but it's still showing us that at some stage we will have spikes, not for the time being, certainly for the next few weeks. Volatility is likely to remain low. The levels that we were looking at have all been broken, and therefore that argues for several weeks of quiet volatility, again matching what we've been saying. ES stays relatively strong, it's NQ which takes the strain. European equities we have covered. Every time they go up to the 200-day moving average, they get sold. There is no acceleration there. We just cannot see it. And this is the important one. We've finally broken the range, upside favored now. So we are looking here for the 9650s very quickly, and it's buy call time in DX, and basically buy puts in Euro USD. Thank you very much indeed, and tweet to you on Monday.